Hello everyone, my name is Fulp. I'm the owner and principal of Carriage House Planning. I want to welcome you today to I would say, rather timely update. Some pretty good news. We're getting really close to some good news. This is a video I'm primarily doing for the clients of Carriage House Planning, but I am going to post this publicly because I think it's valuable information as it relates to our process, our discipline, our investment approach. But the real reason today that I want to reach out and make a video, it is July 21st. Over the course of the past couple weeks, we've obviously seen continuing improvement in the broad equity indices. In the kind of middle to latter part of June, I had put out a piece suggesting that we weren't seeing a lot of breadth in the marketplace. And that gave us some reason to be, I would say, not to say pessimistic, but to pause when it comes to getting overly excited about the notion that perhaps we were in fact out of the darkest downfall of what was 2022, and that we should kind of go pedal to the metal. We were in a position, again, just a few months ago, where we were seeing incredible strength at the end of May, led by like NVIDIA and a lot of these AI related stocks. In fact, to the date, we could look at like the top 7 stocks if we were to take, Meta or Facebook, Apple, Google, Amazon, Tesla, NVIDIA, Microsoft. If we're looking at that kind of group of stocks year to date, they're up about 100% for the year. If you were to kind of look at those collectively as a whole unit of 7 stocks. And not only that, but being that they are large companies, the capitalization of these companies collectively combined is just massive. They make up a much greater percentage of the S&P 500. So when we're looking at the S&P 500, which nowadays is kind of the go-to index for measuring sort of market health and market conditions, these 7 stocks that were doing exceedingly well were really responsible for most of the strength in that underlying index. So we want to be sure that we're getting a lot more strength across the marketplace before we say, okay, maybe we are ready to start bringing in either more risk exposure into a portfolio, meaning the opportunity for growth and loss. Maybe that risk paradigm is shifting where the risk has left the room to some degree, and instead opportunity is beginning to present itself. Here we are in the middle of July, and I'm happy to correct when my supposition for the future is wrong. I want to be wrong, especially when I'm saying that the evidence is suggesting that things may not be as good as they currently look. That also means at times that we might miss out on a little bit of performance, but I would much rather have evidence supportive of a environment where risk is appropriate to take because there is a valid opportunity for reward or a valid opportunity for growth or appreciation of investments. I want to get to an environment where that relationship between risk and opportunity is more in balance. And there's a number of ways that you can measure that. There's infinite ways effectively that you could manage it. But today I want to focus on one of our primary indicators that we use. We consider it kind of our master equity indicator. We also use the same process for determining this indicator's value for all asset classes. So it's not something that's exclusive to equity. But the good news is that in some ways, in a certain way that we use this indicator, we have received our first of, let's call it green lights. We like to use that terminology. I think it's easy to digest. Green light meaning we can go. That being said, we have not yet received confirmation of that green light. So it's not yet ready to go, but the idea that we've already received that first indication that in fact we may be done. We may be done with the pain for this particular market cycle. That's really exciting. That's something that we want to be encouraged by, and we of course want to be ready to take advantage of opportunities as they present themselves. But I wanted to use today to sort of revisit for some of you, but also introduce to those who are not yet really familiar with it, from a conceptual side of the conversation, sort of how that indicator is looked at, and sort of how it helps us govern decisions in terms of not only the investments that we make, but whether or not we are taking risk or not taking risk. I'm going to steal kind of an analogy that's often used, especially in the realm of more technically driven investors, and that is, offense and defense, and whether or not you have the right, let's say, team on the field. Forgive the sports analogy; it may not necessarily resonate with everyone. I could easily use a car analogy in parallel with this, because that's something that really speaks to my mind, but. With the sports analogy, the idea is you need to determine whether or not the football, and that's what the sport that we'll use in this case, or we could use baseball and say whether or not we're batting or we're fielding. But in the case of football, is your defense supposed to be on the field, or is your offense supposed to be on the field? So to some degree, that's what that master indicator is really trying to help us understand. Now, if your defense is on the field, that doesn't mean that you put guys out there who have their hands, wrapped up in clubs where they're unable to catch the ball. Interceptions can occur. So that's why I think I like that analogy, because it's not to say that you're completely taking any and all opportunity for progress out of consideration. You're just simply putting up big walls. But you're saying, we know for a fact that we are on defense. Now, how do we better position our team so that we don't put our star quarterback out on the field and potentially risk him being hurt, or potentially not using his skill set to the greatest advantage? And instead, let's put those linebackers and those defensive backs and safeties and of course a defensive line up. As those indicators move around and as the signals that they provide us are received, we can then better determine, okay, is it time to, let's say, put on special teams, for example? Well, you're not really on defense, you're not really on offense, right? In a special team situation, like let's just say a punt situation, to some degree you are on defense, because of course they could fake the punt, they could do a number of different plays that would require defensive action. But generally speaking, the signal suggests that you should be ready to go on offense. I would say that's kind of where we are right now. We need to have somebody in the back who's ready to run, who's fast, who's ready to go, because chances are that ball is in fact going there. But we're not quite there yet. So again, we're not ready to put the quarterback on the field. We're not ready to put the star wide receivers out on the field and the fullback who's just a freight train. We need to get full confirmation. But with that, let me bring up some visuals to, I think, help sort of guide our conversation here. First things first, this is a snapshot of the S&P 500 index and where our current green light signal and then confirmation is going to be, assuming we're on trajectory. Now, I will note right now, both of these particular indications, they are going to vary as the markets evolve. So these are not fixed static numbers. These are numbers that adjust over time. Part of the reason for that is what this indicator is built upon is finding a way. In our case, we've and through a lot of back testing and through a lot of research, we've identified that this gives us a very good understanding as to whether or not there is a more preferential risk to reward opportunity set for equity. In this case, again, we're using this to govern equity-based or domestic equity-based decision making, versus taking the risk-free approach, or risk-free, and I'm going to use air quotes in that case. Of course, there's going to be some inherent risk, the government default, whatever, but taking something like a money market or a treasury bond, a short-term T-bill type of investment approach. Is the risk to reward relationship for equities better than the risk to reward relationship for the risk-free investment class? Or is it the other way around? So when this particular indicator signals a red light, that basically says that the opportunity for reward in domestic equities is now significantly outweighed by the risk for loss. And in the case of a risk-free asset, you're much less considerate of or concerned with the opportunity for reward as you are the downside protection. So what we're looking at in kind of a duality, if you'll let me use that term, is while simultaneously evaluating the risk-reward relationship of domestic equities, likewise, we're looking at the kind of inverse, which is the reward to risk relationship for the risk-free assets, because of course upside potential for those types of assets is going to be severely limited. So one could say, well, if you're looking at it from strictly a risk mitigation perspective, your risk-free investment is the only investment you should pursue. But we know, of course, we have taxation, inflation, we have a number of other factors that do in fact hurt an investment in a risk-free, again, big fat air quotes, risk-free investment class. So taking on risk when appropriate in things like domestic equities or international equities or commodities or fixed income, whatever we're evaluating, it can be very beneficial. So in this case, recognizing we did in fact get this green light signal, we're waiting for that confirmation light, which in the case right now, evaluating the S&P 500 index, we're looking for a target price of closing above 47.14 roughly. Now, what is kind of interesting about this is if we look at the S&P 500 ETF, which is a tradable investment that is built intentionally to mimic the S&P 500 index, we've not yet received that green light signal. In fact, I took this chart this morning before markets opened. And of course, as of right now recording, we are up a little bit for the day. So this is a little better than what it was in the pre-market noted here at 453.82. But we're looking for 458.65. So we're close to getting that initial signal, but we're not quite there yet. So that becomes an interesting consideration and just another point of validation for this indicator, because a tradable utility like this, a tradable investment, a vehicle to invest in the S&P 500, has a number of other factors associated with it that you don't get clarity from when looking strictly at the index itself. One is, in order to package up any type of investment, there's going to be an expense associated with it. So that is important to consider. This is a very low cost investment, but it does have an investment cost or a expense ratio attached to it. Additionally though, this type of utility is going to have options trading on it. So there's going to be a derivative marketplace that's governing this price to some degree. Now that also occurs on the S&P 500 index, but when we're looking at this in a tradability perspective, you don't trade the S&P 500. So if you're someone who is monitoring, let's say, the options marketplace to govern very short-term, very speculative decision-making on the S&P 500 ETF, you might look to that options market, and that might in turn cause intraday reactionism to this position that's not reflected in that broader index. So in a sense, you can get a better, I would say, feel for, a better taste for what the market's behavior is really showing us versus what the underlying price of the index is telling us. The S&P 500 index is just simply aggregating the weighted capitalized weight of the underlying 500 plus or minus a few constituents of the S&P 500. So there's of course going to be tradable variations for each of those 500 plus or minus a few stocks, but the idea of owning the index itself, we want to kind of see, okay, how does the market feel about that amalgamous blob that is the whole index? So the idea that this has not yet reached that particular green light signal says to us, okay, let's be optimistic, but we're not ready to pull any triggers. I'll sidebar for a moment and suggest that part of the reason I'm recording this is I have had some questions. Why aren't we really participating in this big upswing that we've had since late 2022, October, November, December 2022? Why do we continue to lag behind the equity markets? And I would tell you that this is the exact reason. We don't yet have that level of confidence that we need that in fact we are done with the selling pressures associated with this market. It should be noted that we have a lot of major economic pressure out there. Now that's not to say that things in the marketplace, the capital markets, the investment markets, can simply ignore things like a recession. They can. That can happen. I frankly don't care as much about a recession as most people are inclined to do. The financial planner side of me, of course, does. I have to monitor the potential risks associated with job markets and that type of thing, so that my clients, who have any kind of potential risk associated with that, we need to make sure that we're planning around that. But as far as an investor goes, I frankly don't care as much about recessions. What I do care about, though, is how recessions are perceived by the market, and we know that R word is not off the table yet. It's still out there, and it's very much looming. there's a lot of continuing evidence that is festering under the surface. We hear about these great jobs numbers, yet if you actually dial into them, they're not as good as they're being treated in terms of the headline kind of market. We can say there's the same thing about inflation. The inflation numbers on the core level are good, but the real inflation experienced by the average American remains much higher. And those types of factors, they can impact the market. So again, we want to make sure that there is an appropriate relationship between opportunity for appreciation in the investment and the risk associated with going after that opportunity. I mentioned earlier that I might use a car analogy, and it's kind of to say, okay, if I know for all intents and purposes that I'm about to go drive in rush hour traffic, it is 4:45, and I know that I've got to go somewhere where I'm going to use like the highway or something to that effect. Here in Tampa, 275, it's an absolute nightmare. I'm not going to go and say, I know what car I'd like. I want a Formula One race car. That would be an absolutely atrocious decision for the known or at least perceived roadways. Now, something crazy can happen and rush hour traffic may not materialize, but if the weight of the evidence suggests it's probably going to be rush hour traffic because it's Tuesday at 4:45 or Friday at 4:45 or whatever, I probably shouldn't decide, hey, the best car for me to drive right now is a Formula One car. Frankly, the best car to drive probably doesn't even have a manual transmission. In the case of what I prefer to drive, which is a standard or manual transmission, I'm going to go, give me the automatic, because I'm going to go stop and go, stop and go, stop and go. And it's just going to be a little easier on my left leg. But again, whether the football's offense, defense, special teams, whether it's we know what the presumed roadways are to look like, let's select the right vehicle to get us to our destination. Right now, the vehicle is not pedal to the metal, the fastest thing we've got, the most aggressive, the most, whatever it is for your individual risk tolerance. It's let's continue to maintain some sense of conservatism as it relates to the portfolio until we get those signals that then provide us confirmation. Speaking of confirmation, going back to the S&P 500 index, let's notice the spread between where the green light signal will trigger and where that confirmation light comes in. It's about a 4.8% difference. So once we achieved that green light signal, we still needed to get about a 5% appreciation in the S&P before we get that confirmation. We have a history of a lot of unconfirmed signals dating all the way back. We can back test our indicator back into the 1900s, the early 1900s. Some of it's not as valid simply because markets worked in a very different fashion. But with that, unconfirmed signals are not something we want to act on. We want to see that kind of confirmation that gives us a kind of, it builds upon the evidence that we're ready to take action. We need to have a weight of the evidence in favor of taking some type of action, and in this case, bringing more potential for growth, but also more potential for risk into the portfolio. Now, looking at the SPY, again, we haven't triggered that signal yet, but this particular spread's only about 1.6% difference. That's significant. That just goes to show, again, the risk-reward relationship for something that is a tradable utility with an expense and with a lot of other factors involved. It's giving us a different dynamic. In the grand scheme, that spread difference doesn't really play out to mean much of anything. However, when we're in the moment where we're getting signals, if I'm 20 years down the road looking back at this, I'm going to say it's a wash, right? It's a 3.5% differential between the two. Not to say it's peanuts, but you're okay saying, okay, let me wait until I have the weight of the evidence in my favor before I make a decision or take action when you're looking back at it. But when you're in the moment, we do tend to pay attention to it. We try to look at it and say, okay, in a perfect world, I'm going to get a confirmation on both of these, on the index and on the underlying tradable asset. And then we take our discipline for the governing process for calculating this indicator, and we go and apply it to a number of other calculations, including things like small cap equities and mid cap equities, as of right now, international, and if you're a client of ours, you know this. If you're not, we've been very bullish on international equities for some time, primarily because this master indicator suggested that we do have a green light in international equities, and that came in many months ago. So, we have a heavy weighting towards international equity in our portfolios, but we really wanted to see this domestic market improve before kind of bringing ourselves up to what our target risk, would be in a constructive, a general, let's call it bull market for lack of a better word. Okay, I want to move forward a little bit, because what I want to kind of highlight now is, when did this signal turn red? This is that same chart zoomed in a little bit, but here we are on the S&P 500 index. We have that green light signal. Okay, here we are kind of in between. We're waiting for that confirmation, but when did it turn red? What was the experience like? How successful? And I want to be very loose in using the term successful. Any indicator that you use for markets is not going to be right 100% of the time. If you go into it thinking that, you really ought to ask yourself the question, if there is such a thing as a perfect indicator for investing, why doesn't everybody have it, and why doesn't everybody use it? If it existed, we wouldn't have a market to invest in, because everyone would share that exact same thing. Therefore, the efficiency of markets would be out the window, and there would be no opportunity, because everyone would be doing the exact same thing at the same time. Every investment, every trade, every action you take when you're placing capital in an environment for future opportunity, to be it chase an idea or chase a trend or invest in something that is conceptually, fundamentally sound, or whatever your discipline is, there is always a counterparty trade. There's always somebody on the other side of that who is suggesting that their view of the market does not agree with yours. So again, there's no such thing as perfect. What we want out of an indicator is we want something that works significantly more often than it does not work, but also an indicator that fairly evaluates when the risk in the marketplace doesn't have anything to do with the risk allowing for opportunity, but the risk for downside is mitigated in a way that is repeatable, and mitigated in a way that helps fulfill our long-term goals individually, absolute, not respective of others. Because as investors who are not day traders and speculators and all the other things that so many people think they are, but in reality, they're not successful at doing it. And secondly, it doesn't help you get those long-term financial goals that you really are planning for, the things that you're working so hard for. Don't cloud your own vision, I would say, and instead recognize that risk mitigation is paramount to long-term financial success. So that's what this is designed to do. So in this case, notice this red. This was the participation from the absolute all-time high in 2021 down to where we got our red light signal. Now, you participated in about 22% of the downside if you bought the S&P 500. Now, we use this as an indicator for participating in broad domestic equity. So we're making secondary and tertiary decisions underneath this. We're not just buying the index, but let's just assume you're an AB investor. A is you buy the S&P 500, B is you sell the S&P 500 and you buy short-term treasury or money market. If that be the case, you participated in about 22%, 21.83% of the downside. The red light signal came in, it popped down, moved back up quite handsomely, in fact, and then you're sitting there saying, well, this thing didn't work, it didn't work, it didn't work. And then we came back down, actually retested those initial lows where we sold out effectively, and we captured the protection of about 4.6% additional downside. Wait a minute. I experienced about 22% downside, and that only protected me from an additional 4.6%. Well, remember, right here, you thought you were making a foolish decision. Here, just before you get to that pinnacle low, you don't know that the market's about to turn around. And in fact, here we are now with an unconfirmed green. We still, to this point, there's no possible way that we can know that we don't just go straight down from here. Is it likely? It's becoming far less likely. Is it possible? Sure it is. So to say, oh, this doesn't really do much for me, I would say kind of hold off real quick. Now, dating back to before that previous signal came in, let me take you all the way back here to 2020. Now, this was the COVID event that occurred. We know that, well, we know a whole lot more now that some of us speculated on early on, but we didn't have any evidence, so it's just nothing more than a good theory. But as we're learning, things were not going the way that everyone was told they were going with regards to COVID. But the reality is, markets got really, really nervous here. We had this very aggressive downsell, and it came very fast, very hard. In this case, our signal came in about 26 to 27% downside participation. Ouch, that hurts. Now, again, assuming the AB investor, S&P 500 or cash / money market / short-term treasury bills. But in this case, it protected you from an additional 9.8% downside. So instead of experience peak to trough, something to the tune of 26 to let's say 36, 37%, it capped you out at 26. You're feeling pretty good when you got to the bottom here. But then it turned around and you're waiting patiently. It came up, the market kind of sold back down, kind of came right back down to where that indicator level was, which is kind of an interesting behavior of the market. And then it kind of began its crazy ascent. But what I think matters here is the level of uncertainty in the market at that time. Let me put you in the Wayback Machine. Let me hit the dials on the H.G. Wells time travel and go position yourself then. Try I beg you to try to remember how desperate everyone was for hard and fast information. Nobody had a clue what was coming next, right? Governments were telling people you're not allowed to even walk your dog. You're not allowed to go outside and exercise. God forbid you go out and be healthy out in a park by yourself. Don't you dare go to the beach, let alone go to work. Oh, and we'll figure it out, but don't worry. And then there was, don't go to restaurants, but then you get pictures of politicians having private parties at restaurants. Or don't, do this, but logically you're saying this just doesn't seem to make a lot of sense. I'm telling you this because at that time, nothing made sense. It was all kind of crazy. And then to have the Federal Reserve come in and say, we're basically backstopping small businesses, we're backstopping the individual households, we're going to start just basically printing checks and send them to people. And everyone was kind of shaking their head and they're going, well, Italy, everybody's dead in Italy if you read the news. China, everybody's dead in China. And then you started seeing every single day the ticker tape wasn't about the stock market, it was about how many people died. There were horrific things that happened during COVID. I'm not going to deny that. But I would say in retrospect, within the confines of what we're talking about today, when looking at the market, the most horrific aspect of everything was the tremendous amount of uncertainty that everyone had. No one really had any way to find clarity. So I'm happy to know that we had an indicator that was saying, okay, enough pain, let's just step away from this for a little while. In this case, though, what's really wild, this rarely happens in history. This thing triggered us back in less than 3 months later. Now, because this is a broad participation indicator, very rarely in history do we have it trigger back and forth that quickly. To an extent, in our case, we're looking at it and we're saying, is this a false indication? We've got our indicator, we've got our confirmation, but even then, unlike today, where, if we were looking at today's, if I got this green light, I'm saying it's time to go. We've missed a lot. It's time to bring risk in. But in this case, we were still going, are we sure we want to trust this right now? Fortunately, we did. That played very much to our favor. But that's the key about an investment discipline and about indicators, is you have to know that they are time tested. And while everything may be different this time, in other words, this indicator may not work all the time, as a whole, as a long-term investor, it works more than it doesn't. It hits singles and doubles more than it hits home runs, right? But it also doesn't strike out nearly as much. And that's just another sports analogy because we might as well just go with it. We'll just keep them going here. But where I think we can also look back with hindsight and say, okay, maybe this gives me a little bit more, a better taste in my mouth. Is even though, yes, you got back into the market a good bit higher than where you got out of the market, and again, we're just going to continue taking that AB investor that either I buy the S&P 500 index or I buy, treasury bills and short-term risk-free type of assets. From the point where we got back in to peak, we participated in about 68.5% of the market's ascent. So to say, oh man, we missed out on 27%. Yes, darn, I hate that. But you have no possible way of knowing you're at the low when you're there. The only way you really know is, well, frankly, once you're here and you've surpassed it. But even if in our case where we got our signal, it's like, okay, we have to trust the discipline. We have to trust the process. We got back in. We participate in 68% of the upside. Now, since then, you've already seen the downside participation, but let's assume we're not kind of calculating our own successes based on peak to trough and that type of thing, and just saying, when did we get in, when did we get out, when did we get in, when did we get out, or when did we take risk, when did we draw back on risk? From the point where we entered the market to where we received the red signal that came in at the end of 2021, in the middle of 2022, we participated in 31.75% upside. Now, you annualize that out, and that comes in to about, give me a second here, I've got my figures in front of me. There it is, a 14.65% annualized growth. Now, again, we're balanced investors in most cases, or we're looking to have a layer of diversification in a portfolio. We're not just AB investors. But to say, based on this discipline, based on this concept, to have a 14% annualized return over this period, even though, yes, you ended up taking some of the losses to the downside, that's a successful strategy. The fact is that beat inflation and taxes handedly over that period of time. And it protected you from a little bit of an additional slip here, but most importantly, again, going back to 2020, it saved your butt because there was so much uncertainty. And if you didn't take some type of evasive action, you were just guessing, you were hoping. Any decision that was made needed to be made based on some form of process, discipline. Otherwise, it was just a guess because so much was unsure at that time. Now, speaking of unsure, let's go to another time when things were unsure. This was the last red light prior to the two that we've received during COVID/post-COVID run-up. The 2020 to 2023 time frame, we had two red light signals. Kind of weird. It was a weird world. It still is a weird world. But let's go all the way back to the great financial crisis of 2008 and 9. Now, in this case, this one's going to be hard to make an argument that it didn't work per se. This is what we love to see, but this is also evidence, in our opinion, of this particular indicator successfully evaluating when the risk for downside has outweighed the potential for upside. And in this case, we participated in about 19% of the downside from when the market peaked its terminal closing high, all-time high in 2007, to where we received the signal in the middle of the year in 2008. Now, our initial signal actually came in April, but it wasn't until 2 months later that we got a confirmation that it was in fact a red light. So for that reason, we participated in about 20% on the downside. But then following that, there was an additional 45% from that particular point to trough. So we know that terrible story of what occurred during the great financial crisis and all the losses in people's portfolios and 401ks and just everything that occurred. And the real pain of the situation was the fact that so many people missed out going forward because they were so hurt by, so scared of, so terrified of the uncertainty. Again, just like in COVID, it was very uncertain. Are we going to have a double dip recession, right? We've never had this quantitative easing. What is this QE stuff? Most of you all probably don't remember that. I remember it very, very well. I lived, breathed the stuff at the time. But in this case, by missing out on 46% from here to the pinnacle low, from that point forward, we gave up a 23% pop. So if I were to be that perfect investor with a great crystal ball and I just, I knew everything, I had this omniscient point of view. Well, I got out here and I'm going to buy right there in March, April of 2009. No, I don't know that. Again, double dip recession, what is QE? Ben Bernanke's, the talk of the town at the time. Lehman Brothers had gone under and Citigroup was having its problems, and AIG, don't forget AIG Financial. I mean, the list goes on and on and on and on. Yet we got this signal. April, May is basically May to June, where our signal comes in. We got invested, okay? That going forward, just like we witnessed a moment ago, until these COVID red light signal came in, from the entry point to the peak of the market before the COVID selling began, we were up 301%. I didn't even bother annualizing that, but you can do that calculation on your time if you'd like. It's almost 302%. But what was the experience, signal to signal? So entry and then exit on the COVID, you're still up 194.44% if you're governing your decisions based on this indicator, and again, only buying S&P 500 in money market. I know that's going to get old saying that, but I want to be sure that's clear. Now, most people would be pretty happy with that. It's also important to note, you've got some selling in here, right? We know 2011, we had the fat finger trade. I think it was in France, if I'm not mistaken, the big whale trade. Some corrupt trading mechanisms ended up causing the market to, because it was so packed full of fear, it was just ready to sell off, and boy, did it ever. That was double dip recession. That was, all this other pain. I think by then we were on QE3, if I remember right. It could be wrong on that. But then 2015 and 16 were ugly. We had the Chinese yuan devaluation. We had a lot of other factors at play, and there were a lot of people very concerned there. And then again in 2018, we had the Christmas crash. Right? These were times where you're going, oh boy, here we go again. Here's a bad market. The indicator didn't signal. It did give us two false signals, unconfirmed signals. So we got a sell signal in 2011. With its respective buy, but we never received the confirmation, so we didn't act on it. Likewise, 2018, we got a false signal right there at the Christmas crash, and it came in at the pinnacle low. I think it was December 24th. Got us back in sometime around April of 2019. But again, that was an unconfirmed signal, so we remained invested. It wasn't until those March of 2020 COVID crash sell-off that we got the first real red light that had a red light plus a red light confirmation signal, so we acted. All right. Let's look at another situation. This was the tech bubble of the early 2000s. By backtesting our indicator, we know that in this case, this one was great, right? This indicator gets better and better as we look back in history in some cases. Down about 13.39% before we got our signal. It was a choppy 13.39%, down, up, an emotional roller coaster. At this time, all you had to do was buy something with a .com associated with it, and you just made millions and millions of dollars, right? Until it doesn't work. We ended up getting the sell signal, protected 41% to the absolute pinnacle bottom. So you got out from that point on, you were down 41%, 544.87 points on the S&P 500 index. But once you hit that bottom, from that pinnacle low, from that capitulation point, if you were that perfect, omniscient investor that could see the future, you got in at that perfect point and you participated in 27.47%. We did not. We were waiting for that signal plus its confirmation to come in, so we gave way to 27.47%. It's no fun, but you know what? We had evidence and we had a process, and we trust the process. Now, going all the way back, we can take this back to 1960 in this case, and we can look at where these indicators buy and sell signals came in. The really soft colored ones are false signals. We had a few more false signals dating all the way back into the early 1900s, but we want to look at post-war America. Preferably, we really kind of want to focus on post-gold America, because this is looking at the risk-free rate of returns and it's looking at money market slash, treasury bills. When Nixon officially killed off the remaining sliver that was left, forgive the pun, sliver of gold standard that was left with the dollar, markets changed in a lot of ways. That was the birth of the fiat currency for the U.S. It was used primarily to fund the Vietnam War. We won't go into that. A lot of history there. It's a really interesting history. But the reason that it matters for us is, again, we're looking at, is the risk-reward paradigm for equities, in this case domestic equities, going to be better than the risk-reward paradigm associated with that risk-free investment class? Well, if that risk-free investment class has had a major shift, we want to be mindful of that. Likewise, though, we want to be mindful of the fact that I mentioned QE1, QE2, QE3, right, 2008. At that time, the Federal Reserve shifted us from the scarce reserve models of monetary policy to the abundant reserve model of monetary policy. We went from having a market-driven interest rate to a Fed-driven interest rate. Even though they controlled the overnight lending rate, by having scarce reserves, they could not determine what the market fed back in terms of reactionism to the rates. The rate marketplace was now governed by a printing press, and that was the Fed's printing press. If I could overlay a chart of the federal deficit and the federal debt on top of this, you would, I think, get a much clearer picture. I didn't do that for today's charting, but the takeaway here is this very well may have been a paradigm shift where this particular indicator might need to be modified. But we have to be really cautious to say this time is different. We know it worked in 2008. We know it worked in the tech bubble crunch 2000 to 2003. We know that it gave us a lot of solid signals. We saw the Black Monday crash of '87. It got us out. May have been at the worst possible time, but again, uncertainty was the supreme leader of the market sentiment at the time. So the signals came in. We can also see dating back into the early 80s when we had Paul Volcker making his decisions around breaking the back of inflation. We had a number of signals. We had a sell, a buy, an immediate sell again, another buy. Okay, that was good. It got us back in. At that time, everyone was scared to death because the overnight lending rate went from 11 to 23%. That was the Fed fund rate. You had mortgages that were 18 and 19%, I think, at peak in most cases. Funky world, right? Really weird environment. A lot of people would say, well, if I'm going to pay that much in interest, I should put it into the bank, in the savings account, and I should get my 12, 13, 14%. But in this case, we know that market appreciation, equities would have probably been an optimal investment based on this signal. We can see a lot of things happening. The real takeaway, though, is having a discipline, and having a discipline that you stick to, is absolutely necessary, especially as humans. We have a bad habit of letting our emotions run supreme and our emotions guide and govern our decision making. And we can also be quite talented at fooling ourselves into believing that what is actually an emotional decision was very rational and very well thought out. But more often than not, if you stop and say, okay, what evidence, what information, what data is governing this particular decision, it's very hard to come up with that. I was listening to an interview with William Bernstein, and he said something to the tune of, and he's a behavioral scientist, a psychologist, but he's very much involved in the investment world and understanding the economics and the behavioral sciences around financial decisions that people make. And he said something to the effect of, we prefer, or we really love narrative cotton candy over data-driven spinach. And I just, as soon as I heard that, I was like, that is just beautiful to say it that way, because we love stories, and we will eat that all day long, no matter how unhealthy it is for us. But as soon as I put a plate of data-driven spinach in front of you, you kind of look at it and, I don't want that. Well, when these red lights and green lights come in, more often than not, market conditions are, ew, don't give me that nasty spinach, right? Give me the cotton candy, give me the story. But more often than not, at that time, the story really isn't there yet. If somebody's spinning you a story, you should have your spinach first. Give me the data, okay? And then I'll believe your story. But if it's just a story, which has been what has been driving up this NVIDIA-driven, tech-driven, this ascent in the market so far this year, has been very, AI is just going to change the world and happy, everything's going to be great. Where's the data? Show me this. It doesn't mean it's not there, but I don't think most people are eating the data-driven spinach. I think most people right now are consuming the cotton candy. And until I have data to suggest that we have, in our case, received our green light signal and our green light confirmation, I'm going to be a bit weary of the narrative cotton candy. And that's because at the end of the day, risk mitigation should be a primary objective for long-term investing. And that's what we're going to continue to do at Carriage House Planning. For those of you who are not clients, if there's anything that we can do for you, if you have questions about your portfolio or about your financial plan, perhaps you don't have one, give us a call. We'd love the opportunity to talk with you, learn a little bit more about you, and see if in fact Carriage House Planning might be a good fit to work with you. And for our clients, I hope that this has been enlightening and insightful. It may be a refresher for some of you. It may be an introduction for others. But this hopefully will help add some color or understanding as to why it is we are in fact choosing intentionally to lag the market to some degree right now. Hopefully, fingers crossed, we get that confirmation, we get that kind of signaling that we're looking for. But until we do, we can't in good faith make decisions that we would look back on and say we made those simply out of pure luck and hubris. That would not be advantageous for you. It would not be upholding of our fiduciary standard, and more importantly, it would just be a dumb decision. Even if it works out, it's like I'll leave you with this last sports analogy, but I listened to an interview talking about, and I couldn't tell you which course, couldn't tell you which tournament, couldn't tell you anything about it, but we all know Tiger Woods kind of holds the crown as far as golf, and he was evaluating like 3 holes that he had played. And the interviewer said something like, that was such a beautiful, a beautiful chip, and then kind of a beautiful whatever his next shot was, and then you just missed that putt. And his response was something more to the effect of, even though those first 2 the interviewer thought looked beautiful and they were great, he was like, it was a shoddy, chip. It really was basically, in his eyes, 2 bad shots. And he said, but it was a really good putt that just didn't go in. Because he knew, based on his processes, the first 2, they were just blind luck. And he was honest enough with himself to say they were ugly. They were not good swings. They were not good contact with the ball. He knew they were not good. But to the layperson's eye, or even the educated eye in the case of the commentator, they're looking at it going, that was beautiful. They went exactly where they're supposed to go, but he knew that's not what he meant to do. But the putt that didn't go in the cup, he was like, it was just perfect. It just didn't happen to go in the hole. Having that kind of mindset with a portfolio is hard to do, but it will benefit you long term. So I'll leave you with that. Thanks for the time today. I hope you have a great rest of your summer. And if there's anything we can do, give us a call or reach out to us through our website, www.carriagehouseplanning.com. Talk to you soon. Bye-bye.